In today's video, I talked to John. John is 52 years old and he wants to retire in 3 years. He has some really cool things he wants to do in retirement, but he's concerned about sequence of return risk and the impact it might have on his plan. Listen in as we share the two things that everybody needs to know to help reduce sequence of return risk, as well as the specific portfolio adjustments we recommended to John to help him alleviate that risk in his plan. It's all coming up next on today's Retirement Makeover. Joining me for today's Retirement Makeover is John. John, thanks for joining.
Thank you for letting me be here. I appreciate
Happy
the
to have you.
opportunity.
Absolutely. You are 52. You are looking to retire in about 3 years. Do you mind sharing some of the challenges that are top of mind as you think about that?
Sure. The biggest challenge for me, I'm not really concerned about the amount of money that I've saved. I've been diligent my entire career, and because I live in a high cost of living state and area, I've had a considerable salary. So the percentage of that has led to a considerable amount of money. But because I'm retiring, or I plan to retire at 55, I have concerns about sequence of return risk. And then I've always made more than the maximum allowed to contribute to Roth. And so I have no tax-free savings at that point, and conversions to Roth are a concern for me. And finally, I've had some health issues. And so medical insurance and those options are very important to me.
Absolutely. 3 years from today, is there a significance in that and you want to retire what is, relatively speaking, a fairly early retirement, or is it just feel like the right time?
No, actually, it has to do with the third option. So my company will allow you to buy health insurance at the company's cost if you're 55 and have any years of service. Think of it like permanent COBRA instead of 18 months of COBRA. I thought that option would be important, although, I know that marketplaces exist and stuff like that, but that's really more than anything what's driving it. And the fact that I don't think if I retire earlier than 55, I would be able to remain sane. There's really a question as to whether I'd remain sane even after 55. I have to come up with basically a new career where I don't need to get paid and I can volunteer my time, but I need to do something to keep me busy.
What do you think that will look like?
I've had some ideas, some of them crazier than others. I was mentioning to Lucas in our preamble to this meeting, when I went to go decide on college, it was between engineering and the law. And I don't regret my decision. I have a dual degree in engineering and I work in the medical device industry. We save people's lives every day. It's a great career, but law is always the road not taken. And so the crazy idea is like go back to law school and then just work for free the world probably doesn't need another lawyer, but they could use probably a free lawyer. And so, there are lots of people that need people to fight for them in the law that, can't afford to pay. And so I always really enjoy learning new things. On the other hand, spending that amount of money and going back to law school just for fun seems crazy, but it's probably within the financial ability of my plan. But it just seems crazy to go back to school at 55.
I've heard of some crazy ideas. That does sound crazy. I mean,
Yeah,
maybe
see?
just me going to law school.
Right? So I'm like, this is crazy. And then I excise it from my mind and then I'm showering and it'll like pop back up and I'll be like, oh, it would be kind of fun to learn something new.
Well, you know what? You've got an honorable intention for doing it. So I think that's great. If you can endure those 3 years, that's great. So let's go to the numbers, John. This is great. So just to summarize, 3 years from now, you become eligible for this healthcare plan where maybe you use it, maybe you don't. There's other options, but you at least get the ability to maintain the same healthcare plan you're on now going forward, at least. So Medicare, I would assume. The challenges, of course, are when you retire early, sequence of return becomes a bigger risk, simply because there's no Social Security kicking in to help alleviate any of the burden of expenses or anything else like that. You do have a longer window to implement things like Roth conversions if those are of value. So we'll explore that. I want to touch on sequence of returns, though. In your mind, what is the risk of sequence of returns? How do you understand that?
Well, my understanding of sequence of returns, and I have just enough education on this to be dangerous, but not to be useful, is if there's a prolonged downturn in the market, say 2 to 3 years, your stocks are going to decrease, let's say 30, 40%. And then because you're withdrawing, there's never a chance for them to recover. So, I've lived through several downturns and it's never bothered me. But because I'm going to be living off of those, and right now my mix of equities versus bonds is way probably too far into equities, I'm going to be essentially burning capital that never has a chance to recover. And so depending on the year that you retire in, say 1968, you could be in really bad, trouble. Everybody uses like 1966 as an example. And then if you retire in like 1984, you're golden. And so that's the risk.
Well put. Yes, the risk is, to your point, hey, if you're working in the stock market, has a prolonged downturn, it's not pleasant, but it's not the end of the world. You just keep plugging money away, you keep earning an income, and it doesn't impact you. If you're retired and there's a prolonged downturn, now you are forced to liquidate these holdings, these investments that now don't have the chance to ever recover simply because they were sold and liquidated to fund lifestyle or living expenses. Let's go to your plan and your numbers and see how might this impact you. And so if we start, John, this is your balance sheet. So just a summary of where you are today. And just to summarize, you're in a good spot. You've put yourself in a good spot. You've had a healthy income. You've had a healthy investment and savings rate along that time. So you have cash here. You have different investment accounts. So you both have taxable accounts. So you have these accounts here, just under 500,000 or so. You have your qualified accounts. So 401ks, IRAs, et cetera. All in, you have about 3 million or so in invested assets, and you have your home, which I know there's plans to relocate. Is that in retirement or even prior to retirement that you're planning on doing so?
Probably prior to retirement, but the house gets paid off in December. I have like practically nothing left on it. It's just going to run out. Basically, the payments are going to run out. But it's my intention, because I work remotely now in my current role, that I can relocate to a lower tax and lower cost of living area.
Perfect. So we'll see that right here in one of these goals. And just to summarize your goals real quick, goal is to retire at 56. So this really means work through 55.
It's 55, and then the bonus gets paid sort of in July, so maybe 55 and a half. But, I'm one of those people that's like, just can't let the last bonus go. I know in all of in Ari's videos, you're like, don't be that guy. I'm that guy.
Hey, it's hard not to be that guy sometimes. There's reasons to get that. And then expenses here. So these are your core monthly expenses of what it would look like to live. And I think you even said that you're maybe even living on a little less than this today, but that you just want to make sure that you're projecting a healthy enough amount. Is that right?
Yeah, I track my expenses using, it was Mint and now Rocket Mortgage. And so I have a good idea of what I spend. I currently spend on average 60,000 a year, a little more, so 5,500. And then the extra 1,000 is what I anticipate taxes and insurance to be on now that I won't have a mortgage. So when the mortgage drops off, that's what I expect my base expenses to be, assuming everything remains the same. If I move to a lower cost of area, I think it'll go down, but that's worst case.
Yeah. Okay. So 6,500 worst case. If you don't spend that all, apply it to the law school degree or something, but no harm in over projecting a little bit. Annual retirement health cost. I'm assuming this is the cost of what it would take to maintain your current coverage through your employer once you met the eligibility requirements. Is that right?
My employer would actually be half that. So for the plan, I assumed that it would be sort of worst case, which in doing a little bit of research came out to about $1,500 a month for me as a single person who hasn't smoked. But, I'm open to ideas on whether or not that's realistic. Okay. But if I get the company coverage right now, I pay practically nothing now, but if I have to pay for the whole thing, it's about $850 a month.
Okay. Got it. So we can come back to this, but again, erring on the side of being conservative and over projecting some of these costs, let's keep that here. Annual retirement long-term care costs. This is just a default that we include. May happen, may not. We're just including last 2 years of life. In home care national average is about $68,000, $69,000. So we include some of these things just to make sure there's not something that we're over projecting or failing, I should say, to project. But these are, of course, some big unknowns. Vacations. Tell me what you want to do on vacation. $40,000 per year.
I travel for work, but traveling for, not work is a lot better. And it just so happens that that would cover the cost of law school also. So like if the first 3 years were law school instead of vacation, you could read that in. But yeah, I mean, I haven't scrimped. I have a very good affluent lifestyle, if you will, but I don't have any reason to take the money with me. And so there are a lot of places that I haven't visited that I would like to and explore.
Yeah, very good.
But I view that account as basically like, it's not just, I mean, it says vacations, but it's, extra spending above the base that I wouldn't normally do while I'm saving for retirement.
A slush fund to be
Yes.
used on travel, law school, any number of things that come up.
Donations. Who knows?
Donations, any of the above. New car. So I think this is great. Every 8 years, you're planning to have an expense, $50,000 there. So good to be planning for something. Here's the primary home relocation. So assuming that you purchase a home in Nevada next year, purchase price $400,000 essentially means the equity in your home today would be sufficient to cover that. And then you'd have a little bit left over that we're projecting here, or a decent amount left over in your plan. Very good. So income today, healthy income, like you mentioned, you have Social Security coming in. That Social Security benefit is a healthy amount, but the whole thing with sequence of returns is what do you do to bridge the gap between this when this ends and this when this begins? Not that the two are equal, of course. Your income is going to be a lot higher than Social Security, but high income, then nothing in income outside of investments. And then about a decade or so later, you have Social Security coming in. So the risk of poor returns in those years is what we're going to explore in just a second. In the meantime, you're saving a healthy amount, you're maxing out your 401k, you're contributing to your investment account. Now, is this something that you're contributing $2,000 a month to, or does this tend to come from a year-end bonus or stocks vesting?
No, so I currently contribute $1,000 a month, $500 biweekly because I get paid biweekly. And then this anticipates that I take half of my house payment and start contributing that. So it'll essentially be $2,000 a month. But if it needs to be more than that, it could be $3,000 a month because that would be I could move my entire mortgage payment into taxable. That's where all the bonds are right now and the only bonds that I have. So I'm trying to build up that taxable account as quickly as possible.
Yeah. Yeah. Okay. That makes a lot of sense. And this ties directly into what we'll talk about next, which is what will those cash flows look like when you're no longer working? And what I mean by that is today you have income. Salary is coming in today. That's going to stop partway through 2027. Once you receive that final bonus, salary cuts out. Zero income for the next several years until 2039, when we assume Social Security starts kicking in.
And I know that Social Security is also intertwined with like Roth conversions and stuff. So I'm open to starting Social Security at whatever age, would be appropriate.
Yes, that's a good point. This isn't to say this is the only time you could collect earlier, as early as 62. You could collect later, as late as age 70. We'll start with this just to see what do things look like, and then we can see how that decision might impact other things. But I think the bottom line is what we want to see is that the next few years, there's really no withdrawals from your portfolio. Because when we compare your income to your expenses, these expenses, even as we project them out, even with housing, so housing, yes, you got a little bit more of a mortgage payment, but then that really drops down pretty dramatically, especially once you move and property taxes go down. Healthcare, we're probably over projecting that expense at $20,000 per year, when in all likelihood it might be about half of that, as you mentioned, but we're projecting that out. Here's all those expenses. Here's those goals, whether it's a new vehicle, whether it's vacations every year. There's a property purchase, of course, next year that we're looking at, projected taxes. But once this year hits, 2028 is the first full year of zero income. Here's what your portfolio needs to do. You need to take $161,000 from your portfolio so that you can fund your goals. So fund travel / law school / giving / slush fund, whatever that ends up being.
Right.
And then have enough to pay for healthcare, pay for housing, and have the equivalent of $6,500 per month, I should say, left in today's dollars. That number starts fairly high right here, and it stays that way until Social Security kicks in. And even it actually goes up at that point, because these first few years, as you'll see, you see zero tax payment. The reason this is showing zero tax payment is simply because the software is modeling out you drawing down your brokerage account first.
Right.
You draw down your brokerage account first. There's really not going to be any taxes that you're paying on that, most likely in your case, because you can take advantage of capital gain harvesting. You can live on money that's already been taxed. You could have a situation where there's very little taxes. I'm going to put a pin in that because we're going to revisit that when talking about Roth conversions and are they worth it or not. But this is the amount that you need to pull out of your portfolio, you're projected to pull out of your portfolio. And this matters when it comes to sequence of return risk because it helps us to identify what's going to be the withdrawal rate of your plan. There's two things that I think everyone should fully understand when it comes to sequence of withdrawal, sequence of return risk. And that is, there's two main risks or two main factors to that. One is a high withdrawal rate, and one is a high level of concentration. If you are withdrawing on a higher end of your portfolio, and if you are overly concentrated in certain assets, you are increasing the risk of that sequence of return risk. You're increasing the chances that a bad or prolonged period of down markets could really disproportionately impact you and your ability to do what you want to do. So what we're looking at first is the first one of those things, the withdrawal rate. Are you taking too high of a withdrawal? What this is this is taking those numbers we just looked at. What are the net flows from your portfolio? What are the withdrawals from your portfolio? And dividing it by your overall portfolio balance or your projected portfolio balance at the time that you retire. And as we look at this, John, your withdrawal rate is solid. This is a very sustainable number. Now, granted, you're retiring on the earlier side. There's general rules of thumbs or general approaches you can take, like the 4% rule, like the guidance guardrails approach, where anywhere between 4, maybe 5.5%, depending on the approach that you're taking, and you can be reasonably sure that money is going to last for 30 to 40 years in retirement and have a very low chance of running out of money, which is, of course, everyone's goal number one in retirement. Your withdrawal rate is well below those numbers. So on the one hand, I don't see this and say, hey, you need to be extra concerned about sequence of return risk. Everyone should be concerned. Everyone should have a plan to address it, but I don't see this where it's at 5%, 6%, 7%. A lot of times in those first few years, your withdrawal rate's actually higher because Social Security hasn't kicked in yet. And you can see what does happen when Social Security kicks in. Your withdrawal rate actually drops to the 1.5% range. You see these spikes. This is when, every so often there's a car purchase. And so there's an extra withdrawal that comes out. But on average, once Social Security kicks in, you're in the 1.5% range. Prior to that, you're in the 3 to 3.5% range. Those numbers really reduce your risk of a prolonged downturn, sacrificing your ability to retire or limiting your ability to stay comfortably retired. The other thing is high concentration. But before I go to that, any questions on this so far, John, or is that making sense?
No, it makes perfect sense. And, I'm one of the byproducts of working another 3 years is that I can keep the withdrawal rates, low. I don't plan on whatever's left goes to my sister, and I love her, but she gets what she gets. She doesn't need the money either. So, I want to be responsible and not blow it on the 1 yard line.
That's a good way of putting it. And let's take a look at the other part of this then. If your withdrawal rates aren't too high. And by the way, the reason that high withdrawal rates magnify your sequence of return risk is because if all of your money is invested in one thing, for example, and that one thing, call it the S&P 500, is down 40% in a year. Well, if you're taking another 1 or 2% of that, that's very different than taking another 6 or 7 or 8% of that.
It's just a math problem.
It's a math problem. Exactly. Here's the concentration portion that I want to go to next. And part of this is looking at your plan, and part of it is looking at another tool that will help to illustrate some of these things. But let me go to your investments. If we look at your investments as a whole, we see, and ignore this target allocation here, this just by default says this, look at current allocation right here. What we do see is the majority of your account, a majority of your portfolio. When I say your portfolio, I mean all of your different accounts combined. It's pretty heavily invested, I should say, in US stocks. There's a little bit in bonds. There's about 7.8% in bonds, 1% in real estate, just under 7% in international stocks. So fairly heavily concentrated in US equities. Now, US equities over the last decade and a half have been the place you would have want to have been. It's been the best performer, at least among the top performers. If we knew for certain the last 10 years of performance, the last 15 years of performance, we're going to continue over the next 10 years, the next 15 years, probably not a reason to change this, because sequence of return risk isn't going to happen. If everything just goes up and to the right, we don't have to worry about withdrawing money when the market's down.
If only we could guarantee that.
If only we could guarantee that. Unfortunately, I can't. But
I can't either, which is why we have to have this conversation, because otherwise I would just be independently wealthy and I would be talking to a supermodel right now.
There we go. I'm not that. So instead, I'll offer you some of this. So this is just a tool that illustrates you. I think you use the year 1968 of, hey, everyone chooses this as a start year and says, look how horrible it would have returned. Absolutely. Now that's cherry picking data. I'm also cherry picking data right here. So full disclosure, this is choosing dates on purpose to illustrate this point, but I think it's important for everyone to know is if you had a portfolio that was 100% large cap stocks, US large cap stocks, your portfolio isn't 100%, but it's a little over 80. So it's fairly close to being there. What this is saying is if we look at how did this portfolio perform from 2000 to 2024, assume you started with $1 million, if you analyze that portfolio, lots of numbers here, but I just want to highlight this. It returned just under 7.5% per year. So it was below its long-term average, but it still had a healthy return. You would look at that number and say, yeah, why couldn't you take 5% per year out of that? On average, you grow by 7.4, you take out 5%. The portfolio keeps growing even as you're taking out your withdrawals is what you would think at first glance. But the sequence of return, or the concept of sequence returns, says, well, what if you start taking money from this portfolio? And just so everyone's clear, this isn't John's portfolio specifically. This is just a hypothetical tool using these numbers. What if you started taking 5% from that $1 million in the year 2000? The average returns would seem to indicate you'd be okay because it's growing by about 7.5% over that time. You should still have a fairly solid balance. But if you actually test this, what you'll see is you ran out of money right about here, right at the end of 2016. And that's the concept of sequence of returns. And the reason for that is you see the first 3 years of this time period, again, I'm using cherry-picked data, but the market was down 9% and you took 5% from your portfolio. Then the next year, the S&P was down another 12% and you took 5%. Then the next year is down 22% and you took 5%. And by the end of those 3 years, your $1 million was down to $470,000. Now that 5% withdrawal, which is $50,000 per year, that's more than 10% of your overall portfolio value. And so you've dug yourself this hole by being too concentrated in one specific asset class. And by the way, you could do the same exact analysis for international investments, emerging markets investments, bond investments. This isn't unique to the S&P. I'm just using this to illustrate what the S&P 500 did because your portfolio is fairly concentrated in it. A lot of people's portfolios are fairly concentrated in it. Maybe not as big of an issue when you're working and adding money to your portfolio, but being too concentrated in anything certainly becomes a much greater issue for the reasons we're looking at right here once retirement happens.
Yeah, I mean, my portfolio is actually exactly the first example. I started my career in 97. I started maxing out my 401k around 2000. I remember the dot-com bust. Yep. And essentially my portfolio benefited from 3 straight years of buying S&P 500 at a discount. And now we're 25 years later and that discount really helps. But I got to get out of that mindset. It's a mindset shift for me. It's tough. Like every time I buy bonds, I feel like I die a little bit inside, but I need to do it.
Yeah. Well, totally. Yes. And let's look at this next thing, because I think those words are so true, not just for you, John, but for a lot of people who have seen their wealth really blossom due to the positive impact of what the S&P 500 has done. And by buying into it, even when times weren't good, and now setting yourself up for that next season to be equally successful, is really important. And so what we just looked at was a portfolio of 100% large cap stocks. If we clear this, and if we say, let's call this a growth allocation, don't pay too much attention to the specifics. Some of this, again, is cherry picked, but just saying, what if you spread your money? You still have S&P 500, so US large cap. You also have some mid cap. You also have some small cap. You also have some real estate, international, emerging markets. You also have some bonds. If we take a look at this, one of the interesting things is, let's get rid of the withdrawal for the first part. If you look at the average return on this, it's lower than the S&P 500 was over this time.
But not bad. Still,
Not bad.
I mean, I wouldn't call it a rounding error, but I mean, you're within spitting distance.
You are, but you're a full 0.5% off. And so you might look at that and say, why? Why diversify and accept lower returns? And when you're in retirement, the way that you win is by not losing. And the way that you lose is having everything or the majority of things concentrated in one position, whether that's real estate, whether that's the S&P 500, whether that's international, it could be a number of things. And you lose the flexibility to draw from whatever's not going down, or you don't have the ability to say, I'm going to be intentional about where I pull my money from. So as we look at this, we say, why would you own a portfolio like this? Well, let's revisit this. What if you start taking $50,000 per year out of this portfolio that didn't perform as well over this time period? Well, it didn't perform as well when you just look at accumulating assets. But the beauty of that, or beauty of this, is you're still in the game. You didn't run out of money in 2016 like you did when all of your money was concentrated in just the S&P 500. It's not been an incredible experience. You're still down $100,000 in terms of total portfolio balance from when you started, but you've been taking $50,000 per year adjusted for inflation all the while. So that, I think, is, as you said, a mindset shift for a lot of people. Is the S&P 500 is 500 plus of the greatest companies in the world, many of the greatest companies ever to exist. And to navigate away from that can be really challenging until we start to understand that every asset class is going to go through prolonged periods of outperformance and underperformance. And it's the underperformance that really is what people are talking about when they talk about sequence of return risk and how do we mitigate that. Does that make sense so far, though, or any questions there?
Absolutely. The best analogy that I've heard, and really is the one that sort of convinced me it needed to happen, was, you're running a high-powered like offense in football or something, and there's a point in the game where you're up by so much, you need to kneel on the ball and not run up the score because there's nothing left to prove. And if you continue to run this like risky offense, you could let the other team back in the game. And I need to not worry about running up the score and just preserve the win at this point. And so I know I need to do it. And that's why I'm buying in the taxable account exclusively bonds. The thing that sort of confuses me is everybody says, don't put bonds in your tax deferred accounts, but that's sort of my biggest accounts and all I have left. And so, it definitely needs to be rebalanced, which is why I need someone like you with your expertise to give me an estimate of portfolio that eventually ends up mitigating the risk we're talking about here.
Yeah. Yes. Right now, there's 81%, not equities, but US equities. Overall, there's 92% stocks. Global stocks, 8% is in bonds. So the question is, what does this need to be to mitigate sequence of return risk? Is it 10% in bonds? Is it 20% in bonds? Is it 50% in bonds? And so much of that question, well, two things. Number one is, and I think sometimes people don't love to hear this, but unfortunately, there's no perfect science for that decision. It could be a very perfect science if we could look at the last 20 years and know that that was going to happen again over the next 20. You could engineer a perfect portfolio for that. All we have, though, is this sense of, yes, different asset classes do go up and down at different times, and sometimes not in perfect lockstep with one another. So how do we best position ourselves with optionality or flexibility within our portfolio so that regardless of what's going up and what's going down, we have something we can draw from in retirement to be okay? So what I like to look at is I like to look at cash flows and say, okay, here's a projection of how much you might need each year in retirement. I think some of these numbers, John, might be a little high because you're projecting on the high side for medical expenses. You're maybe projecting on the high side. What depends maybe on law school. Do you go to law school or is it something different? But assuming these numbers are accurate, you would want to look at somewhere around 5 years of living expenses set aside in something that's not going to be impacted by a downturn in the stock market.
So
5
you
years,
would put it as years of expenses, not percentage of portfolio?
correct.
Okay.
Because the reason for that is a downturn in the market on average, say a bear market lasts about 2.5 years. The most extreme case in the S&P 500 since the end of the Great Depression, it's been about 5.5, a little over 5.5 years it took to recover. So if we have enough dry powder, if we have enough reserves, I think of bonds as like the emergency fund for your portfolio. Like, why do you have an emergency fund when you're earning an income, a healthy income at work? Well, that income might go away. Something might come up. Okay, so you have an emergency fund, but at some point you can have too much of an emergency fund, and that's now costing you because of the cash drag of that money not working. Same thing with bonds. You need to have some bonds because, or cash or something like that. At some point, the market's going to drop. And when you're in retirement, you need to be living on something that's not stocks. Now, by the same token, at some point you can have too much in bonds in the same way you can have too much in your emergency fund. And so the reason I don't think of it as a percentage is because you have $3 million in your portfolio. Just doing some round numbers, some round math here. This is, let's see, 150, 750. I'm just going to pull up a calculator here. If we have 750 divided by 25%, for example, in bonds on the high end. I'm going to talk about why that's high. You maybe don't need that much.
Sure.
That would give you 5 years of living expenses if you retired and the stock market went straight down for 5 years in a row, or at least stayed flat for 5 years in a row. Let's say you had 6 million in your portfolio, so you exactly doubled it. Does that mean you need 25% of your 6 million in bonds? Not really, because still, unless your spending went up, but if your spending stayed the exact same, it's still that 750,000 that you would need in something conservative to fund those first 5 years without having to touch your portfolio. So that's why it's a dollar amount that you then back into as a percentage of your portfolio, the way I like to think about it, as opposed to just saying have an 80-20 portfolio or a 60-40 portfolio or something like that.
And I think that number is doable. So I have about 250,000 in bonds right now. And then 200,000 from selling the house. So that gets you to 450. And then 3 years of contributions plus 3 years of reinvesting the dividends from the bonds get you pretty close to that number. Mm-hmm. But in terms of location, that would all be in the taxable account. Should I start moving funds over in like the 401k or the IRA to bonds also? Or does it matter where the location is?
It does matter. You can get away with it in a couple different ways. The most simple way is if you put that money in your brokerage account. The reason you do that is that's where you're going to be spending money from first, is the brokerage account, most likely. Because that's
the brokerage account also has about 250,000 in stocks from when I was splitting it 50-50. And those have a significant capital gain. So I didn't want to sell them because I didn't want to take the tax hit.
And it's not a bad idea to keep some stocks in your brokerage account as well, because again, if we knew that the markets were only going to go up, we wouldn't have any bonds.
Yeah. Those years I can pull from the stocks and keep my powder dry for the bonds.
Exactly.
In case it's like year 2 through 5 that has the problem.
Right. And I think that's where people get a little bit confused. They think, okay, I retired and I immediately need to start living on the bond portion of my portfolio. No, like in the same way, you don't immediately start living on your emergency fund as soon as it's fully funded. You leave it there as dry powder in case something happens to your job. So having optionality, having two different asset types is really helpful. Also keep in mind that even when markets are dropping, there's still dividends, there's still interest being created from your accounts. And dividends and interest remains pretty resilient in general, even when the stock market drops. 2002, for example, we just looked at that in the S&P 500. The S&P 500 lost almost 50% of its value before recovering. The dividend on the S&P 500 fell, I think, 2% during that time. So you still do have an income source in some sense. There's still some cash being generated from these assets that can go towards meeting the shortfalls, which is why I say you maybe don't need the full 750 or so. But that's the basic logic of where do you think, or how much should you have in bonds versus how much should you have in cash when this all begins.
Okay.
Does that make sense as we look at the reason for some of this?
Yeah. Absolutely. So, and it is one of the options that I knew existed. And so I think having that amount in essentially, safe bonds in my taxable account, 5 years worth of expenses is a doable thing in the next 3 years.
Yeah.
And then for the IRA and the 401k, so right now it's in the 401k, it's 80% large cap and 20% international. There isn't a lot of choices in the funds there. And so adjusting that in the 401k would be difficult. It's either that or target funds. Essentially, they don't have a lot of choices. But but in the IRA, I can obviously move stuff around, and it has my one individual stock. I'm very proud of the fact that I bought Berkshire when everybody said Warren Buffett was stupid back in 2003 and 2008.
Yeah.
And so that's my one individual stock, but everything else is essentially, large cap, or, QQQ is obviously technology weighted even more than this. Yep. Some of these can be sold and I buy bonds with them if it's necessary, but if it can all be in the taxable account, I think I can get to 5 years of expenses.
Yeah. And even within this, even if you're not owning bonds in this account, and I'll talk about a reason why you might in just a second, but there's still a lot of overlap here. If you look underneath all four of these funds, they're going to have some similar holdings or the same holdings. And so, yes, there's 5 different securities, but you could add to how much you have in small companies or international or emerging markets, which part of you is probably going to be kicking and screaming saying, well, they haven't done anything over the last 10 to 15 years compared to these funds. And again, it's less about trying to hit home runs in the future. You don't need to hit home runs to have a great retirement, but you do need to avoid striking out, because if you strike out, you might need to call it quits on law school and go back and do something. Now, your withdrawal rate's low enough that I don't anticipate that happening. We need to take a pretty significant downturn unless some really foolish decision was made with investments themselves, but it doesn't hurt to build diversification. You can do that in this IRA if your 401k itself doesn't have a ton of options to do that.
Yeah, I mean, it essentially has 4 plans. There's total market, which is 80%. I do now. International, there's like a bond fund, and then there's I can't remember what the other index fund is. Those are the 4 index funds. And then they have 2 growth funds that are like ridiculous expense ratios that I refuse to invest in based on principle. Mm-hmm. And then target date is the choices. But the IRA, obviously, Schwab, I can buy anything available. So
exactly. So you can do that, then you can make the changes to your taxable account here as well. But I think that doing that would really put you in a great position to mitigate sequence of return risk, because going back to the other part of that risk, one is being overly concentrated. Second is taking too high of a withdrawal rate. There's nothing about these withdrawal rates that causes me any level of concern. Again, keep in mind your portfolio as a whole might be generating close to this much just in dividends and interest. So you're not going to be fully living just off dividends and interest, especially because you'll be spending on a brokerage account, and a lot of the dividends in the IRA will be staying in the IRA. But I think this is the main thing that you can control to minimize that. And so I think for everyone listening too, we can't control what the market's going to do the year that you retire. We can't control what the market's going to do the first year that the first decade you're going to retire. But we can control our withdrawal rate, and we can control our level of diversification, which sounds like a boring word. Why would I diversify when this S&P 500 has done so well? It may even continue to do well. But if it goes on a 5 to 10 to 15 year streak of underperformance, you might not be around to see it recover when your portfolio runs out too quickly, if you're overly concentrated and taking out too much.
Yeah, my goals are just different now. I mean, my goals the last 30 years have been growth, and now they need to be stability.
Yeah.
With a little bit of growth, because I can't give it up completely. I can't quit it all. Can't quit it cold turkey. Just sort of wean myself off of it.
Doesn't mean getting out of it fully. It just means making sure you have enough other things to complement it. Very good, John. Any other questions about the sequence of return risk component and mitigating that in your plan?
No, I it all made perfect sense to me. And I think, targeting 5 years of expenses is really, what I was looking for, because there's lots of information out there. Some people say sequence of return risk is bunk. I think that's a little weird. Some people target percentage of portfolio. Some people target percentage of withdrawal, their years of withdrawal, but it all makes perfect sense. And I think 5 years is a reasonable factor of safety.
Yeah.
My cash balance is a little high right now because I had a one-time windfall and I haven't moved it into, I'm going on vacation first and then whatever's left. I'm celebrating paying off my house. It only happens once.
Yeah, it does. It's amazing.
But yeah, I think it's a doable thing to get it into the taxable account, which is a good place for it to be.
Yeah. Well, very good. Well, John, thank you for taking the time and thank you for being a guest on today's Retirement Makeover.
Sure. Thank you.
Root Financial has not provided any compensation for and has not influenced the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.